Hey, hello everybody. Folks, I'm really stuck in my work, and consequently, I'm not like 100% of myself into the group. But of course, this is you pass out. So just give me some patience to me. But let's review what I wrote to you guys. Let's start with the dark pool spreadsheet. Remember the dark pool spreadsheet? I mean, I didn't update. I update only for today. I need to update for another days because I'm stuck. So, do you know the higher bias that you have in the market nowadays? Both directions, okay? But consequently, since end of the last year, the the biggest bias is to a crash, right? Every time FinTwitch Furos are calling crash, the flow you start to be bearish after the OPEX, crash window, even CTAs, very famous CTAs that manage a lot of money, keep impress the same key. And what's happening? Dealers already realize that we have more bearish investments than bullish investments. Consequently, where the amount of money are allocated more? Bearish investments, right? Consequently, they sold puts. Calls was cheaper. This has been reflected in the book a lot, right? Of course, that I put in another days that where they short the calls or short calls that the days that they spike up, they short calls, they do the basic. Market is basic, really basic. Up, sell calls by put. Down, sell puts by call. I'm not telling you guys to do this every single day, but basically is what dealers do. They collect premium because when market's going up, they need to hedge themselves, especially because the market structure, gamma structure, positive gamma, sell strange, sell rallies, buy weakness, strange, top, sell calls, buy puts, hedge, market go down, reach the support, opposite, sell puts, buy calls, back test some resistance. In the resistance they sell. Negative gamma, they sell weakness, they buy rallies. Consequently, we always see squeezes when we are in a negative gamma. Huge drops, huge melt-ups, faster and furious, because they need to buy to underlie their hedge, right? So, based on the market sentiment, dealers collect money. Look, for today, since beginning of June, because the first order print on June 9. The total premium is $5.6 million. They sold a lot of 4,200 puts. Especially this month. Why? Because the JP Morgan caller. A lot of people I don't have idea why they keep tracking their hedge. This is mandatory. So every quarter they need to build a collar because it's part of the fund agreement. They protect all the investors up 5% drawdown. So they need to build a collar. Also, let's go back to let's check their collar. I highlighted over here, starts on line 2532. Remember that they sold 4,320. 4,320, that's, the call that they sold. Okay? The JP Morgan caller net crash, because before they sold 4,300, but they did, consequently showing over here, but they rechange and then we sold 4,320. They sold for $57.84. Okay, they receive money to build a hedge. They received the net credit was $120,000. Okay, of course that tomorrow if it's not traded at 4,320, they really need to rebuy, the call. But let's see how much it's costing. So they sold by 57.84. So they are losing 4,320. So they are losing basically $20, right? $20. If the market drop 20 points, consequently, since is in the money, this go back to $56. Look how thing it is. If you go back to $56, 20 points from right now on, they will rebuy cheaper than the price that they paid. Okay, and then we could see a spike tomorrow, anytime tomorrow, as soon they need to roll out. They open a new hedge, a new collar. But just you guys understand, they sold by 57, is already 76. If the market go back to 4,372, they are buying cheaper than they sold. Just to let you guys know. Okay, just to let you guys know. They need only 20 points drop. Okay, they will not losing money if the market drop 20 points. Basically, they will readjust deltas. Okay, and we could see a spike during the intraday tomorrow, because will be the time that you see a gamma squeeze, because they will rebuy 4,320. They supposed to be buy another strike that may be something like 5 points above from the current price that you will be trading at the time that they start to open a new hedge position for August. Okay, so we could see a spike in maybe top of the market, supposed to be in the first day, the first trade day after they build the next wedge. So supposed to be on July 3 or July 4, we supposed to be see a green day as well. During the gamma squeeze that you supposed to be see tomorrow, because the delta adjustments. Okay, so keep in mind, 20 points drop from the current price means that they will rebuy cheaper than they sold, right? Because now is in the money. Gotcha? So I really don't know, and I really don't understand why a lot of FinTwitch gurus, whatever they you guys call, look for a JP Morgan hedge. Doesn't make any sense to me. That's poor hedge. That they receive money to build the hedge. That per the fund agreement, they need to build a 5% drawdown protection. Okay, so let's talk about a little bit about today. Coming back, Regarding, the huge buyers, they already, you know, sold a lot of puts and received a lot of premium. Regarding 4,375, why am I looking too much for 4,375? If you check the spreadsheet line 2,737 on June 22, print a big order, strike 4,375. That in some point get negative in 55%. Of course, now it's positive back to be positive. But let's see the price, 32.50. That's how much cost right now, 4,375. So it's already 28.60, right? 28.660. So this person looks like that he sold this call. I said 26, right? 26 something, 26.80. So this person is already making 17.54% because it was a short call. Of course, this person is looking to be below 4,375 up to tomorrow to receive the full premium. If let's suppose that today is the expiration date. So if today is the expiration date, this person is supposed to be rebuy this, but this person will receive 17.54% because it's already down from the price that this person already sold. Consequently, I'm looking for 4,375 as a very key important support because we are trading above the level. But you guys already observed that this player just played delta decay. He sold higher, and consequently, consequently per structure, the delta tends to be burning since it's really close from the expiration date, because the theta, I don't know how big is the theta. Let's see the theta for 375. Theta is minus 1.95. If I'm not wrong, is 10. Let me see. How much cost 10? 10.50 minus 1.98. So per day hold on, my math is wrong. 1.80 88 9.20. So per day markets going against the movement, the theta tends to burn at least 21 cents 21 cents per day as a premium. You need to get the theta and divide per the value that you bought or you sold. Okay, so the theta, the person that sold this one, basically he sold accordingly the theta, because this person knows how much delta and premium especially premium, will be burning during the high theta, because the theta is almost minus $2, right? Minus 2 for 375, almost minus 2. Okay, and then I look for 4,375 as a support. But today, that's very clear in the spreadsheet that they set up 4,375 as a floor. Let's go back for today. That's very clear that set up 4,375 as a floor, because the amount of premium traded yesterday was so low, very low liquidity, and the majority of the calls was concentrated at 4,375 call strike. That was in the book. That was in the book. Consequently, I came to you guys and I told you, where's my, here? I post you guys. In terms of call, 40% is concentrated 4,075. Dealer set up a floor at this level. Right? It's in the book. Was in the book. Very low liquidity, 40% concentrated in 4,375. So they really set up a floor. The strength is 4,397. All those calls were paid out today. And you guys observe the huge amount of short puts. Force to market going up because retail bought those puts. And then they removed the liquidity since 2 days ago because came from 52% up to 49%. Of course, jump, between yesterday and today, 47 to 49, but, it's still going below 50%. Of course, still higher because it's above 44%, right? But the GX went too high, forced a lot of people to buy call, and they sold puts, forced market to go up. And then they set up, a floor at 4,375. Remember, higher GX, the book is already built with, plenty of liquidity, but they remove a little bit, so they know how much money is needed to move the market. If you wanted to get in, you're supposed to be paying higher premium. Higher cost. If you wanted to get out, you're supposed to be sell cheaper, right? This is how liquidity works in the market. Okay, so today was really easy to identify the support. Was like in the spreadsheet Dark Pool. Apologize to not send to you guys. I'm really stuck with my kids. They are in vacation. Pick up them in summer camp. Take them to the jiu-jitsu. Dining out. Getting tired at home. So I'm trying to do my homework. That is to provide the data analysis to you. But I have been delaying other things. And consequently, I'm very stuck in my work too. Okay? So, we're done for today. Just to review what I wrote. Unfortunately, we didn't went up to 4,408, 4,411. We saw a rejection exactly where the strength was set up at 4,397. The top was 4,398, right? And I told you guys, for the morning setup, I'm looking to see a close between green, flat green, between 4,375, of course above because yesterday closed at 76, but more at 4,478, doing the market structure that I saw early in the morning. I post you guys what I told you guys that I was looking for the setup. At 10:45 a.m. Do the current design, I'm seeing per delta will close green but flat at 10:45 a.m. and I'm still looking for a close around 77 and 78 because that was the structure that defined 10:45. But match the delta that they set up yesterday and consequently match the option, the dark pool book that they set up yesterday. Okay. I was thinking to give okay. And just to finish, this. The current support 4,309, right? But now I'm looking to be breaked very soon. Why I'm looking to see? Oh, this is. Let me go back for today. let me close over here, hold on. Why I'm seeing to for 4,390 will not hold XPX. The Thinkorswim, when I share my screen to do the videos, getting really slow. Because like it's a very basic stuff. It's a very basic stuff. You guys that play options need to know how to identify that. We have almost 50% negative deltas going to the put contracts, right? It's already 49. So we are in a transition to see 4,390 as a resistance. And why I'm saying that, why you'll be really easy to break down and bring market back to 77 and 78. Because as you can see, you have 30 Vegas in both contracts, right? 30 Vegas in both contracts. And we had higher implied volatility in the put contracts compared with the call contracts. So since the Vegas is stable in both sides, any abrupted change in implied volatility tend to burn premium. Since now is below 4,390, how much? It's 4,398. So consequently, stable Vega, higher volatility in put contracts tend to burn call premiums and tend to put premium in the puts contracts. Consequently, I'm seeing that it will be easy for the dealers to break down 4,390 and open the door to bring market back to 4,378. Okay, guys, I finished by here. I finished right now. Thanks again for everything that you guys have been doing for me as well. And try to follow the book that I sent you guys every single day before, the majority of time before the markets open. But nowadays, with some delay. The really important is to follow the levels and try to understand, how the structure works. Is everything based, in the option book? It's because the option book where the money is located. It's not supply and demand. It's not support and resistance. It's not Fibonacci. It's not EMA. It's not MACD. It's not TRIX. It's not ADX. It's not RSE. This is like pure indication tools that all the mathematicians use to track the movement of the market, because we at that time we didn't have too much options going on, right? Nowadays dealers use the option book to move the market. They have the power to move the market through the options grid. Consequently, if you guys study a lot market structure, you guys will be able, to identify movement and levels much more accurate for old style people that never, take their time to learn how the structure works, how the machines calculate premium. This is what I try to do every single day to you guys. Of course, I'm much more able to commit a mistake than the machine, because the machines, monitor every milliseconds and do a mathematics every milliseconds, calculating where the price is located, right? Usually I do once a day at the close, because the machines already build the big picture for the day after. And consequently, I came and I write everything to you guys. Deltas don't lie. And yeah, sometimes I go against myself. And when I go against my analysis, I mess it up. I mess it up. Always. When I follow exactly the book, I'm succeed. I'm succeed. The only problem is myself. The only problem is ourselves. Because sometimes we forget to look the books and we forget to believe in the deltas because deltas don't lie. Deltas don't lie. Never, never, ever. Because the money is there. The money is in the option books. And the deltas are the option Greek that move the market up or down. Okay? Guys, I'm finished by here. Love you guys. I'm looking for 77, 78 at the close. 75, as I explained before today, is the key level.